Okay, well, welcome everybody. We'd like to get started for our EITF meeting today. We have a number of individuals that are on the phone today, given the brevity of our meeting. And so before we get started, we want to just do a bit of a roll call to understand who we have on the phone today. In the room, we have Kimber Bascom and Bob Yule. EITF members on the phone, Paul Beswick.
I'm here.
Great. Jim Campbell.
Here, and thank you for a West Coast friendly time.
We actually were thinking about you, Jim. Alex Coral.
Here.
Larry Dodick.
Here.
Okay. Brett Dooley.
I'm here.
Okay. Mark Lamont.
I am here.
Okay. Tony Sandi.
I'm here, and I second Jim's comment since I'm on the West Coast as well.
Eric West.
I'm here as well, thanks.
And do we have Terry Campbell? We weren't expecting, but I thought I'd try. Okay. The FinRec Observer, Jim Dolinar.
Morning, Sue. I'm on the call.
Great. The PCC Observer, Yan Zhang. Okay. And in addition, for those that are on the phone in the room, we also have the board present as well. So each of the board members are here in attendance today. So with that, I will turn it over to Jason to take us through any announcements that we have.
The only announcement is that we'll be discussing today EITF issue 18B and redeliberations on the proposed update that was issued on 18B, which is improvements to accounting for episodic television series, for which there were 6 comment letters received. And so with that, we'll turn it over to the project team to take us through the redeliberations.
Great. Good morning, everyone. As Jason said, today the task force will consider the feedback and received on issue 18B on film costs. As the task force redeliberates the consensuses for exposure, the task force will then be asked whether it wishes to affirm the consensuses for exposure as a consensus. So the staff will present feedback received on each issue and will then turn it over to the task force for discussion. We're going to start with issue 1 and 2 on capitalization and amortization. So for issues 1, all the respondents were supportive of aligning the accounting for production costs of an episodic television series with the accounting for production costs of film. The respondents agreed that the distinction between films and an episodic television series was no longer relevant for determining the amount of film costs that can be capitalized. Therefore, the staff recommends that the task force affirm its consensus for exposure that would require an entity to capitalize eligible production costs for an episodic television series similar to production costs of a film. For issue 2, all 4 respondents who addressed amortization supported the proposed amendments related to the reassessment of estimates of the use of a film in a film group and other related conforming amendments. 1 respondent recommended that the amortization guidance should be clarified to explain how an entity should estimate the portion of the indirect ultimate revenue generated by direct-to-consumer subscription services that is attributable to an individual film. Another respondent suggested replacing the example in the proposed update, which references a cable entity that receives a subscription fee, to an example of a direct-to-consumer subscription service provider that uses viewership data for amortization. The staff recommends that the task force affirm the consensus for exposure to require a reassessment of estimates of the use of a film in a film group with any change in estimates accounted for prospectively, and to make other related conforming amendments to the amortization guidance in subtopic 92620. And now I'll turn it over to the task force for discussion on issues 1 and 2.
Okay, I'd like to open it up for any questions or observations. I'll first do that for the folks in the room. Any comments or observations, Bob or Kimber?
I agree with the staff recommendation. Right, the first issue is the main one, the reason why we started this, and good to see that the comment letters agreed with that. And then I agree with the staff recommendation that you should continue to update your estimates and do the amortization prospectively.
Kimber?
Yeah, I also agree with staff recommendations. The only comment I have is related to the example that one of the comment letters also commented on 9/26/2035 relating to using a cable company versus a direct-to-consumer type of entity. I understand the technical accuracy of the example, the way that it's written. I don't disagree with it. I do think it might be worth considering the comment, though, that was received about using a direct-to-consumer entity rather than a cable company for that example, just because it might be, it's more aligned with the reason for having this discussion in the first place. And I think probably also is the case that for cable companies, it's less likely that they'll have a film that's predominantly monetized with other films, even though it could happen. So for those reasons, I'd probably think about doing what's in that comment letter suggestion, but I don't disagree with the technical accuracy of the example the way that it's written either.
On the phone, any comments?
This is Jim. I'm supportive of the staff recommendation.
Sue, this is Larry. So with regard to the first point, we agree with the staff. I agree that was the purpose of, really the initial purpose of this whole project, was to align the two, and that makes sense. We also agree with the staff as it relates to the second point about amortization. But we did have 2 points as it relates to amortization. One is that there was a comment letter that was raised in situation when you have a film that's predominantly but not solely monetized on its own, so it has some elements of indirect revenues, and there was a comment that was raised about maybe using or acknowledging that the hypothetical licensing fair value method should be used. And I think the staff's paper suggests that it's not that they have a problem with that, but maybe they should just include that maybe in the basis for conclusion, not to preclude that there might be other appropriate methodologies. And while we agree with that point, we think that it's also helpful to have something within the standard itself to acknowledge that when a film is predominantly but not solely monetized on its own, that for when you have elements of indirect revenues in the computation, that an entity should also be able to avail itself of making, reasonably reliable estimates that, is kind of mentioned in 92620-35-2. And the way the standard is written now, that guidance is only there for situations when a film is included in a film group and doesn't reflect the fact that you might have indirect revenues in a situation when a film is predominantly but not solely monetized on its own. So we think it would be helpful to allow for that kind of guidance or to acknowledge that a company could make reasonably reliable estimates, to acknowledge that within the standard itself and not just in the basis. And I know we've talked to the staff about whether that's best by amending the intro to 92620-35-2, or whether it'd be best to include that within the guidance in 92620-35-1. We're indifferent whether you do it to either paragraph, but we think it'd be helpful to do that. That's one point. And then the second point is, as the staff mentioned in its paper last time, as there's no reason why an entity, once having a film in its film library, would need to remove it, we think that it would be helpful to include in the standard itself that the extent of amortization, the boundaries, if you will, should be when a film is substantively abandoned, and we think that it would be helpful to at least, the simplest thing might be just adding the word substantive before abandoned in 92620-40-5 as a helpful way to clarify that, but we'd be indifferent if you wanted to actually add a paragraph, within 92620-35 to say that. So those were the 2 points that we had on amortization.
I mean, this is Jim, and I think as we kind of reflect on the comments and going from your pretty specific guidance toward a business model that is evolving toward channels of distribution, if you will, where you may have a content is initially released on a pay for the view rights specific to that particular content. It might be a premium channel. It might be a premium subscription service, or it might be an individual title showing on its own for a while. And then the business model is that it then moves into a different class of service and it's made broadly available, and it loses its specific identity to a large extent, right? And those business models and those practices are becoming more predominant. And so when we think about the language, I would just encourage us that the individual words come with, are accompanied with meaning, and if there's a orientation is to keep this broad, right? So that, preparers have, latitude, and don't accompany this with a level of false specificity that, frankly, starts to have diminishing returns when you have a title that moves from an individual title into a library of thousands of titles, of trying to associate, the economics of the revenue stream as it progressively loses its identity over time. So I would just encourage us as we, modify this around the perimeters, that we just be thoughtful and mindful of that.
Other thoughts on the phone?
Sue, this is Paul. I'm generally supportive of where the staff's recommendations, but I guess Larry raised 2 points. In response to the first one, I'm actually not supportive of including additional guidance in the standard. I think that's just one method of valuation, and I'm concerned about sort of singling that method out. And I'm also actually not sure of the scope of that valuation method and how it would be applied in practice. And so without further analysis, I'm not comfortable including that. It was only raised by one person, and when we did outreach, we felt like our valuation folks could handle this, and so I wasn't supportive of adding additional words to the standard itself around that.
Any thoughts on the second point?
I thought the standard was fine as is. I mean, if it gets people over the threshold, that's fine. But I thought, as written, it was fine.
And any thoughts on Kimber's suggestion about the example? While you're on the platform.
I was going to say, this is turning into a little bit of a grilling. No, if people feel like that would be helpful, then we can certainly do that.
Okay. Others on the phone?
Hi, this is Eric West. I'm supportive of the staff recommendation, and I also like Kimber's suggestion of updating the example to be a bit more relevant in the current environment. But I don't feel strongly if if others choose not to include an updated example, but I think it's a good suggestion.
Any thoughts, Eric, on the suggestions that Larry made on those 2 points?
I think including something about fair value in the basis of conclusion is reasonable. And with respect to the abandonment, I thought the standard was clear. We talked about this before we issued the ASU, so I appreciate Larry's point. I understand his concern. I don't think that is something that needs to be addressed in the standard. I think that if it's effectively abandoned, it would come through in an accelerated amortization.
Okay. Any other thoughts on the phone?
So this is Tony Sonde. I agree with the staff's recommendation, and I also agree with what Eric said about Kimber's example issue. And I support the inclusion of comments or discussion about the fair value in the basis for conclusions, as Larry had suggested. With respect to his second suggestion, I think it's, with the abandonment issue, et cetera, I'd go along with what Eric just said.
So just so that I'm clear, I think Larry was suggesting we elevate some of that fair value guidance or the determining the estimate into the actual COD itself. Are you supportive of keeping it in the basis?
I would be fine with putting it in the actual COD. That's, okay. Certainly the COD could use a little bit more on fair value. That's fine.
Yeah, and Sue, just to clarify, I mean, the specific methodology, that is fine by me to include in the basis. What I was referring to is that the standard should make it clear that those having indirect revenues, when they have situations where a film is predominantly but not solely monetized on its own, should also be able to avail itself of the notion in 926.2035.2 that an entity can make reasonably reliable estimates, which the way the standard is written now is only available to individuals that have a film that is in a film group. So unlike what Paul said, I was not suggesting that you had to have the one methodology acknowledged within the standard. It's that you should be able to make reasonably reliable estimates, and then you can look to the basis for conclusion, as the staff has indicated in paragraph 20 that they plan to do, in the basis for conclusion that, hey, maybe one of those estimates might be a fair value kind of approach for licensing. So just to clarify.
Okay, thank you. Any other thoughts or observations, either in the room or on the phone? Any thoughts? Do you have any thoughts on what Larry's suggestion was, either Bob or Kimber?
This is Brett Dooley. I agree with Larry's kind of clarification. I think that would be helpful to have up in the codification, and I agree with the staff's recommendations on the others. On abandonment, I too kind of thought it was already clear that you'd get it through accelerated amortization, so I would have not made that addition.
Thanks, Brett.
I was okay with Larry's recommendations.
Okay.
Personally, I don't think it's necessary, but I wouldn't object to it.
Okay. So how about I call the vote this way? First, I'll call the vote as, or I'll take the vote as outlined in terms of question 1 and 2 that's on page 4 and 6 of the issue summary supplement, and is specific about affirming the consensus for exposure that requires an entity to capitalize eligible production costs for an episodic television series similar to production costs of a film, and then The staff also recommends that the task force affirm its consensus for exposure to require a reassessment of estimates of the use of a film in a film group with any change in estimate accounted for prospectively, and to make other related conforming amendments to the amortization guidance. I'll call that as a group, and then I'll call separately the suggestions made by Larry. I think inherent in the affirming the consensus for exposure on these first two questions is changes to the example to make it more relevant. I think I didn't really hear anyone in the conversation that we had around the table that took exception to that. And so I would group that example enhancement in with this affirmation. We'll then talk separately about each of Larry's additional suggestions one at a time. So, by show of hands in the room, who would affirm the consensus for exposure on question 1 and 2, on issue 1 and 2? Okay, we have 2 in the room that affirm it. On the phone, which includes the example, and then on the phone, Paul?
I would affirm.
Jim?
I would affirm as well.
Alex?
Affirm.
Larry?
I would as well.
Brett?
Affirm.
Mark?
Affirm.
Tony?
Yes.
Eric?
Yes.
Okay. So the first suggestion that Larry had was to provide some additional language in the codification which would discuss the monetization strategy, the predominant monetization strategy, but not when it, making estimates when it's for the indirect amount of revenue, and to acknowledge reasonably and reliable estimates for that indirect piece. Did I say that relatively correctly, Larry?
Yes, that's right. That is.
It's really about the indirect piece and making sure that we have language in the COD that acknowledges the ability to make that reasonable estimate outside of the context of 926-2035-2, which talks about it in the context of a film group. And so Larry's making that suggestion that we provide additional language in the codification for that. By show of hands in the room, who would support that? Okay, we have 1 in the room. On the phone, Paul?
I would not support it.
Okay, Jim Campbell?
No objection, but kind of qualified with being mindful of degree of specificity.
Okay, Alex?
I support it.
Larry? Yes.
Yeah.
Brett?
Support it.
Okay, Mark?
I have no objection to it.
Tony?
I support it.
And Eric?
I support it.
Okay, so we have a majority that would support including some language to that effect in the codification. And then the second thing that Larry had suggested was some additional language where we have language in there about abandonment, adding the word substantively abandoned. And so I would call that enhancements to the guidance that's already been proposed. To that effect, who in the room would support that? Okay, we have 2. On the phone? Paul? Sorry.
I think, as other people said, it's unnecessary, but wouldn't object to it.
Jim?
I think it's unnecessary and would be a no.
Okay. Alex?
I support it.
Larry? Yes. Brett?
I don't object to it. I'm fine. Support it.
Okay. Mark?
Yes, I support it as well.
Tony?
No objection to it.
Okay. And then Eric?
I don't think it's necessary, so I wouldn't support it.
Okay. I think based on the comments and the votes, I think we have support to move forward with including that additional enhancement. So why don't we move on to the next set of questions, Adriana?
Great. Now we'll tee up issues 3, 4, and 5 together. Issue 3 addresses the unit of account used for impairment testing. That is, whether an entity can use a film group for impairment testing. And issue 4 addresses impairment indicators. The 5 respondents who addressed the proposed amendments related to issue 3 and 4 generally agreed with the proposed definition of a film group and the use of a film group as a unit of account for impairment testing and the proposed impairment indicators. However, 2 respondents suggested improvements to the requirement that an entity be required to assess the predominant monetization strategy of each film when capitalization of film costs begins, and the prohibition against a change to the initial determination of the predominant monetization strategy for that film. Those respondents noted that because distribution models evolve over time, entities should be allowed to reassess the initially determined predominant monetization strategy when changes in the monetization strategy occur. Based on respondents' feedback, the staff recommends that the task force affirm its consensus for exposure for the proposed definition of a film group, the proposed impairment indicators, and the use of a film group as a unit of account for impairment testing. The staff also recommends requiring the reassessment of the predominant monetization strategy of a film when the monetization strategy of that film significantly changes from the strategy determined when capitalization of film costs began. In addition, the staff recommends adding a significant change in monetization strategy as an impairment indicator for an individual film. The staff acknowledges that the monetization strategy of a film could change after the capitalization of costs begin. Therefore, the reassessment of the predominant monetization strategy of a film would result in the unit of account for impairment more appropriately reflecting the way the film is predominantly monetized, individually or in a film group. On issue 5, the impairment model, all 4 respondents who addressed issue 5 supported aligning the impairment model in subtopic 920.350 with the impairment model for films in subtopic 926.20. Respondents commented that the use of the fair value model in subtopic 926.20 is preferable to the use of the NRV model in subtopic 920.350 because the fair value model is more consistent with the impairment model used for finite-lived intangible assets. Based on the feedback received, the staff recommends that the task force affirm its consensus for exposure to require entities to apply the impairment model for films within the scope of subtopic 926.20 to license agreements for program material within the scope of subtopic 920.350. And now I'll turn it over to the task force for discussions on issues 3, 4, and 5. Just 6 is separate, yep.
It's issues 3, 4, and 5, but questions 3, 4, 5, and 6.
Oh. Yeah.
That gets a little confusing.
Okay. So any questions or observations? Kimber?
Just a question on the change in monetization strategy. Would that be a two-way street? In other words, would the guidance, in essence, require you to change your approach if you go from a predominantly monetized as an individual film to predominantly monetized as a group, and conversely, if you go from predominantly monetized as a group to predominantly monetized as an individual film, would it work both ways? Is that the intent?
I think theoretically, yes, but when we did do outreach, most people noted that it would probably be more common, and I say that loosely because the point was, this is probably not a common occurrence in general,
Yeah.
but if it were to occur, it would probably be from individual over to group as opposed to in the other direction, but it could happen.
I guess my thought on that is, I think, to me, having the guidance written in a way that requires changes in consideration of changes in your strategy to affect the change in your accounting makes sense, because we don't know, sitting here today, exactly how business models might evolve and so forth. So that makes sense to me. I do think it should be a two-way street, though, because, again, we don't really know, sitting here now, how things could evolve. And it seems like, to me, for the model to be durable, we ought to write it that way so that it can, it can adapt to future changes in the way companies are managing their content.
Bob?
Yeah. I agree with staff's recommendations. I think they make sense. On Kimber's point, I agree. I think it should be a two-way street. I think it was intended to go both ways. At least that's the way I was reading it.
It was.
However, the impairment indicator is only for one way, but I think that's okay because I think you need that for when you're going from individual to film group. When you go from film group to individual, I think you're going to get caught anyway on the indicators. On this change in the predominant monetization strategy, just two more points. Just one, I think we need to be careful in the way we write this, because we call it a significant change. Now, significant change is a defined term in 926, having to do with adding content to film. And I'm worried about people getting confused with the significant change we're talking here with that significant change defined in the glossary. So maybe we could look for, but keeping the same concept, maybe calling it a change in the predominant monetization strategy that is significant, or just to create so that we don't.
So what you want to do is sort of to create distance.
Yes. Yeah.
We've started to think
Instead
about
of linkage.
Yeah, how to maybe change some of that language so that the definition, which refers to a very specific paragraph, doesn't tie into what we're trying to say.
Okay.
And one thought we had, Bob, was even changing changing the title of the definition of significant changes, which is what you're referring to, and so that's clear that only applies to that, and then we could still potentially use significant change here, but say it's a significant change in monetization strategy, whereas that's a significant change in, I forgot what the wording we were looking at, but making it clear that that would be a different significant change.
Great. So it sounds like you got that point handled. The other thing that I think we need to add, I think you're aware of, then we will also need to put into the guidance, the COD, that you need to, because it's based on looking at change in predominant strategy, it's you gotta, what's your starting point? And so we need to put into the COD, when you first have to define what your strategy is, which I think would begin when you start to capitalize costs.
And I think, Bob, that is in paragraph 3512, but I think as we've previously talked, maybe moving it, and that's an impairment paragraph, so moving it out of that. But I think that currently, as it was proposed, that was already defined as when you would start capitalizing the cost.
Correct. Yeah, but I should have been more clear. Moving it out of
impairment indicator.
Where?
Anybody on the phone with any thoughts or observations?
Sue, this is Paul. I had a couple questions for the staff. My first question is, we're using this phrase, predominant monetization strategy. And in the paper, we talk about the mix changing, but I just want to be clear in my understanding so that as I think about this, if I originally thought I was going to I had a film and I thought I was going to take it through the theaters, and then at some point I say, no, I want to put it on my streaming service, but I still have some theater revenue, so I do a limited release and put it in 10 theaters. Does that say that I can't avail myself of this because I'm just changing the mix, because I'm still going to have either theater revenue or I'm going to have sales on a particular site where you could buy the movie? Does that say I can't apply this, or how would I think through that?
So when the staff was drafting this, the intent was to not focus on the mix, because we thought that would lead to a lot of looking back and a lot of quantitative analysis. And so the point was to really have a significant change in how you were going to monetize that. So a change in the mix should not come into play.
Maybe to add on to that, Paul, I mean, I think you could say that that's a change in your strategy, and so then there's judgment in terms of whether that's significant going from a full release to a theatrical release. But if you determine that was a significant change, then you would still evaluate your predominant monetization strategy, which is looking at all of the revenues and saying, how am I going to monetize it on its own or together with other films and license agreements. In that case, depending on where the mix comes into play when you're reassessing it, then you might be in the same spot depending on the direct revenues that you would experience. But the trigger to do that reassessment is it a change in strategy as opposed to, is it just a change in the predominance of that strategy?
Did that make sense, Paul?
Yes, maybe. Yes, we'll say yes.
Okay.
The next question is, we've updated the impairment indicators. It wasn't clear to me and folks I did outreach to. So let's say that I've got a film and I decide to take my film and change my strategy from theatrical release to putting it on my streaming service. Would you be required to do an impairment analysis when you make that change?
That's correct. So that would trigger the impairment analysis. And what I think the task force talked about was ensuring, well, we don't expect there to be a lot of bouncing between buckets, but we also wanted to ensure that one wouldn't want to do that just to avoid an impairment.
And again, to clarify, Paul, as described in paragraph 33 of the memo, we're saying here the indicator would be a significant change in the predominant monetization strategy. So that's actually, and this is maybe splicing words, but I think it's important to have this discussion. The trigger to do the reassessment, as I said, is a significant change in your monetization strategy. But then you're going to reassess the predominance of all the monetization strategy that you have. The impairment indicator would be tied to the change in the overall predominant monetization strategy. So not just the trigger of reassessing, but to the extent that you actually have made a change to your predominant monetization strategy after the reassessment, that is what would trigger the impairment assessment.
So would you assess it under the new or the old strategy?
So you would look at what the current strategy is based on the fair value of that film and the current carrying amount.
Well, but no, what I mean is, if I'm going from theatrical release to including it on a subscription service, so it's going to be part of a group, I make the determination, it wasn't clear to us in how the indicators were crafted, whether you would look at the impairment indicators for the individual film, or whether you would think about them as part of the group.
It's an indicator listed under the individual film, so you would test it on an individual film basis before it goes into the group, based on the fair value of that film.
I think you need to challenge the words, because several of us looked at it and it wasn't particularly clear to us.
So that thought process, though, that Jason outlined is one that you would have expected. It's more about getting the words right in the COD to mirror what he said.
Yeah, so in my mind, if I've got a film and I'm taking it from individual to group, before I put it into the group, I do an impairment analysis. And so if I had a film that when I did the advanced screenings a month before it was going to be released, and I decided to move it over onto my streaming service, and my expectation is it was going to perform, significantly worse than I originally had anticipated, I would expect there to be a write-down before it goes into the group. I don't want people to be able to use their intention to hide an impairment.
I think we're saying the same thing. So
Yeah, no, I think we are.
Yeah.
I think the words are not necessarily as clear as they could be.
we can take a look at that, but I just wanted to make sure we were on the same sort of wavelength.
And I think, Paul,
Yes, we
again,
are.
as you see the drafting, once you actually see a copy of the final ASU, it will be listed under as an individual film impairment indicator of saying this is, you do the impairment on the individual film basis. So I think that will help, but we can take a look at some of the indicator wording as well.
So if I had a strategy that incorporated theatrical release and then the intention to move it into a library, and maybe that strategy had thresholds in terms of the timing of that movement from individual title into kind of a group classification, and that strategy acknowledged that there will be timing differences from title to title that might be situational, but where you're really, but the strategy really is addressing how long is the tail of the monetization when it goes into the group and it loses its identity. And once it goes into the group, it's really portfolio and how you establish brand. There's a lot of considerations that go into associating value to that. So my question, I guess, is that when we use the term strategy, you know, at what level are we thinking about it? Because as a preparer, I could frame a strategy that was actually quite broad. And while I might have timing that are different from the initial expectations of the individual content, but it doesn't affect my overall strategy. I move from left to right, from theatrical to group, and that's how I monetize my content. So it isn't clear to me that the requirement for the reassessment, is not, is generally kind of overcome by the breadth of the strategy. So it's not clear to me.
And I think the intent was that's why we use the term a significant change. It's not just any change in strategy, but a significant change in strategy. So again, the examples that were raised to us is you intended to have a theatrical release of a film, but because you're trying to build the brand of your platform, you decide you're going to completely abandon the theatrical release and exclusively put it on your platform. I think what you described of, okay, we always intended it to be a theatrical release and then to go on the platform, but maybe just the timing of when it goes on the platform, my intent was that would not be a significant change in your monetization strategy. That's just, again, timing, and maybe somebody could say, well, that's a change in your strategy. Well, I wouldn't consider that a significant change.
So I guess with that elaboration, then, should we consider, some of that in the guidance? That illustration that you just articulated, I think, would be helpful.
Kimber?
Jason, on that point about timing, it seems to me like the timing is inextricably linked to the significance of the change in the strategy. So, if you expected to put a film into theaters for some period of time and then move it into a library after that, and you concluded initially that your predominant monetization strategy was as an individual film, it would seem logical to me that if you had the film out for a weekend and you decided I'm not going to leave it in theaters, I'm just going to put it in my library, that the amount of time that you thought it was going to be in theaters versus the amount of time that you decide to actually leave it in theaters once it's out may affect your determination of whether there is a significant change in your strategy. Is that
Yeah, I think there's judgment there. I mean, typically, you would put a film in a theater, and you don't really have much say of how long it stays. It depends on the performance, and so I wouldn't want to think that the timing of the performance of the film is going to change the strategy. That's just, again, a change in mix that maybe you thought the box office sales were going to be, 10x, and it came in at 5x. I wouldn't say that's a change in strategy. That's just a change in actual box office sales. If a company did make a specific determination that, hey, I'm only going to put it in a one weekend release, then yes, I could see that being a change in strategy, a significant change in strategy.
Yeah, I guess what I'm just kind of struggling with is because of the fact that we have a predominance notion in here, it contemplates that you can have a film that exists that is monetized both on an individual basis and as part of a library. That is part of the notion of predominance in itself. So it seems like because of that, the mix has to somehow come into play in your determination of whether there is a change in predominance of your strategy.
Well, but that's what we're trying to delineate with the words here, Kimber, is that the trigger to reassess would just be a significant change in your monetization strategy, not a significant change in your predominant monetization strategy. So you're looking at, do I have a significant change in actually what I plan to do with the film? If the answer is yes, then you're going to reassess the predominance.
I understand.
So I think because of that, we're saying you're not just going to be doing reassessments based on, oh, my box office sales weren't as high as I expected. I've now got to change all of that when what I intended to do with the film is the same exact thing as what I intended from the beginning. It's just the mix of the revenue changed, because we don't want companies, particularly if you think about an entity that does theatrical and on their platform, if somebody was close to 50-50, we wouldn't want them to change every period just because predominance has now changed based on the different types of revenues that are coming in. And so that's why the trigger would be just a significant change in the monetization strategy that would then lead you to reassess the predominant monetization strategy.
And to ease the burden of that test, right? Yeah.
I think I agree with all of that. It just seems to me that the degree of how you expect to monetize it, how you want to manage it to monetize it, will affect ultimately which bucket you're in. It just, even though I agree that we're not trying to create something that requires a reassessment for slight changes in mix, it seems like the changes in mix still become relevant at some level.
I agree with Kimber. I mean, I guess what my continual underlying concern is, let's say I spend $300 million on a movie, and I had initially intended to have it in the theaters and then move it over to my streaming service. But I intended it to be in the theaters for 2 months or, whatever the number is, and when it gets screened or it's out for the first weekend, it's out of the theaters in a week. Absent sort of triggering the impairment analysis, which I'm not convinced will happen now, I'm going to be able to shift it over to the group and lose the ability to do an impairment analysis. So I'm with Kimber. I think that the timing does matter.
Well, Paul, I think what we've described actually, I think, would address your point, because we're saying just because it does poorly in the theaters does not mean you can change it over to the film group. And so you would still have to do an individual impairment for that film and still use the individual film forecast method for that film just because it performs poorly. That's not a significant change in your strategy. So that's why we've crafted the words that way, I think, because we don't want to mix just to change how you can do an impairment.
So this is Tony Sondy. I just wanted to add something to this discussion. I think it seems to me part of the problem that's being raised, or the issue that's being discussed, is really based on the way the markets are working right now. I think the emphasis and the mix that companies used to have between theatrical release and then when the timing of the move into a streaming service, that was different a year ago, it was different 3 years ago, and it seems to me that we're developing these indicators very much on the basis of where the market thinking is today without keeping in mind the fact that it seems to be changing rather rapidly.
And so, what suggestion would you have then for how we might improve this?
This seems to be more, I think we have to be cognizant of the fact that the relationship between theatrical and streaming services is going to keep changing. So necessarily requiring an impairment analysis at the stage that we're talking, at the way that we're thinking about it now, may actually require too much impairment analysis. So I think what we need to do is develop a more strategic approach to it rather than such a specific approach. By the way, I do acknowledge that this is not, an expertise of mine. It's just an observation based on the economics and from some of the analysis that I've looked at. Mm-hmm. But I'm not pretending to be an expert on this.
I would agree with the kind of tone of Tony's comment.
Was that Jim?
Yes, it was.
Okay, just to make sure. Christine has had her placard up for quite some time. So, Christine, would you like to chime in?
So I'm going to change the subject. So do you want to make sure that there's nothing else on this aspect of the guidance?
Well, why don't we finish that discussion point? The conversation that we've just been having on predominant monetization strategy, is there in the related impairment other comments for those that are on the phone?
Hey, Sue, this is Jim Dolinar, and I have to admit I'm probably more confused now in light of, Kimber and Paul's questions, which I thought were very good questions, and knowing that, you're dealing with a very short time frame, at least from my understanding, is it would seem most entities today that do both models, they don't have, I would not expect them to have the theatrical model be the sole revenue stream on a long-term basis. And knowing how long movies are in theaters, it would seem almost always it's going to shift into the other model in a very short period of time outside of maybe blockbuster type hits. And so I think it puts a lot more tension on the question that Paul and Kimber were raising, in that, you might have originally thought it was going to be in the theaters a month, and now it's one weekend, or it was originally 2 months, and now it's 2 weekends. I think those tension points, I think, are very valid, and it didn't seem clear to me how you would do the individual impairment based on the response I heard.
This is a request. To me, this whole discussion has started with, what does a reassessment of a strategy mean? It seems as if the staff, in the paragraph, I think it's 33 that Jason pointed out, could clarify that a change in the expected strategy is different than just a change in the results of the strategy. Because I think what I'm hearing is a change in the results of the strategy. The strategy was, I put something in the movie theater for 1, 2, or 3 months, and then I move it to my platform. Well, to me, if you only keep it in the theater 1 month, and then you move it to your platform, that's not a change in strategy. That's a change in how you execute or the timing of your strategy, but that's not a change in strategy. So I'm sitting here scratching my head a little, wondering what the problem is we're trying to solve. Because the problem seems to be just some clarification of what a change in strategy means, and it's different than a change in how you just execute or the timing of that strategy. And then it's clarification of the impairment test upon a change in your strategy goes both ways, meaning if you move from the theater to a platform and vice versa. I mean, that's what I'm hearing, unless I'm failing to grasp whatever the specific concern is.
Bob Buell?
Yeah, similar to Eric, I think what I'm hearing is discussion around, is change in timing a change in strategy, and then what is significance? Because the way, Jason, I understood the model is you first look at, is there a change in the monetization, and is that significant? So you first look, actual results being different than what you estimated. That is not a change in strategy. That was what we were trying to take off the board and say, no, you don't have to reassess for that. A change in timing, I thought, was a change in your strategy, but now it may not be significant. If you, after the first weekend, you thought you were going to have this in the theaters for months, and after the first weekend it just bombs, and you say, okay, now I'm going to throw it into the library now. That seems that's pretty significant. So I'm wondering if the second thing that we're actually arguing about, which I'm not sure we're going to want to define, is what is significant.
Kimber?
I agree. I don't think we should try to define significant. And I also agree with Eric's comments. What I'm sort of struggling with at this point is if the results of your strategy never can create a change in your strategy that is significant, which sort of seems directionally like where we were headed, then it's not clear to me if that's true. Maybe it's not, but if it's true, then it's not clear to me how your strategy would actually change significantly after you start to monetize a film. Because you've created a plan when you start to monetize it. And if we're saying that whatever happens from then, as your plan plays out, the actual versus what you thought isn't a change in strategy, then what would be a change in strategy?
So I think that's why we tried to emphasize in the memo that we did not think that this would happen that often. The preparer that raised this issue, the change in the strategy, the example they gave, as Jason mentioned, was they acquired a platform. And as a result, there was a significant change in what they were going to do with their films. And I think we're saying something along the same lines. You're going to have to come up with a new way to monetize it. It's not about the mix or the timing. Because if that was part of the original plan, I don't think this would be triggered.
And I think to add on to that, yes, we think this wouldn't be that common, but you had mentioned, okay, someone's not going to change once monetization begins. But I think the point to clarify is capitalization, and when you determine the initial predominant monetization strategy is when capitalization begins. And so there's a period when someone starts producing a film or even comes up with certain screenplays and different things, and then when they finalize the film, there can be significant periods within that. It could be a couple years. And so they're saying even before we start monetizing it, we might decide that, no, we're not going to do a theatrical release for this anymore. Okay. We're going to send it directly to our platform. And so that's really what we're trying to capture, because as the proposed ASU went out, it would say you can never consider, you can't consider results, you can't consider changes in what you're going to do with the film. And so we're trying to take that back just a little bit to say there might be some times where you're actually changing what you're going to do with the film. And so let's allow for that reassessment, but not go all the way to just say anytime your results are changing, you're going to be flipping in and out of a film versus a film group.
I think just to react to that, if that's the objective, I think it would be helpful to talk about the fact that you wouldn't expect to have changes in monetization strategy after the monetization commences unless it's because of an acquisition or something like that, or perhaps said differently, when you acquire an entity that is within the scope of this guidance, you would need to do an initial assessment at that point of the monetization strategy for that content. To me, that'd be another way of accomplishing what I think the objective sounds like now, listening to this, without it being so confusing about, well, is it necessary to look at changes in the results as a change in strategy?
I can't help but wonder if we're talking about, one of the impairment indicators that we're proposing, and there are other impairment indicators that seem, or may appear to me anyway, that could catch some of these other concerns that we have about, when you have a film that you anticipated would be in the box office for 2 weeks, but it's only one weekend because maybe it's not doing that well, factor F would say actual performance subsequent to release failing to meet expectations set prior to release, and give some additional factors that we had improved upon in the proposed update, along with this monetization strategy. So I wonder if in taking, we're sort of talking about this particular impairment indicator in isolation of all of the other ones. And so I wonder if some of the concerns that are being put forth actually get caught up other ways. And
I think partially, I think the other concern, though, is just not only the impairment indicators, but the ability to move it from a film to a film group, and that's not part of the indicators.
True.
And so that's where some of the concern by the comment letter respondents and the additional outreach we did after with those comment letter respondents, what they were articulating was it might not even be impaired, but we just think that, again, take the obvious example of, okay, we were going to do a theatrical release. We're now going to put it on our platform directly. If we required them to, or if we did not allow them to reassess, they would be required to do the individual film forecast method and be required to test that film for impairment on an individual basis when all of 100% of their revenues going forward are going to be subscription revenues for their whole platform. So it's coming back to why this issue was, or the impairment issue at least, was raised initially to say, how do we do an impairment when all we're getting is subscription fees? Well, what the staff was proposing and what the comment letter respondents were proposing is allow that reassessment in obvious situations when we have changed the monetization strategy, not just when our mix changes, but when we've changed what we're doing with the film.
Hey, Sue, this is Larry. I mean, as I read through what the staff was proposing, it was really this latter point that Jason is referring to that I thought we were trying to address. The notions that, the film didn't do as well as we initially anticipated, or, we're going to do it for, we were going to release it for 2 months and now it's only going to be 2 weeks. I mean, I thought the other indicators were addressing those. D talks about changes in release plans, and F was talking about actual performance not meeting expectations. I thought those things were addressing that. I thought this was just simply there to say, if you thought you were going to have an predominantly as monetized on an individual film basis, but now because plans changed and it's now going to be put on the platform, we needed to allow people the opportunity to do that, but you got to test the film before you move it into the film group. That's all I thought we were trying to do.
I think that's right. I think that's absolutely right, Larry. Any other comments on this point before we move over to what Christine wants to talk about?
Sounds like everybody might be ready for a change of subject. I have 2 questions for the EITF members, and it's related to the proposed guidance in paragraph 926.20.35.19 that deals with the allocation of impairment losses within a film group. So the proposed guidance is that the loss, the impairment loss attributable to a film group is to be allocated to the films within the film group on a pro rata basis using relative carrying amounts, which I'm fine with. But then it goes on to say that there's a fair value floor that should be applied whenever that fair value can be determined without undue cost and effort. And so my questions arise because in the context of 926.20, the notion of fair value is not an exit value. It is a notion of fair value that's estimated based on the expected cash flows that the film can generate, discounted back. And so my question for the members of the group is, first of all, how do we anticipate auditors are going to interpret that notion of without undue cost and effort when the inputs are internal to the management? So they're estimates that management would have to come up with on their own. And then my second question is whether there's any concern that there is some inconsistency between the implication there that the cash flows can be determined at the film level, when the definition of a film group is that it's the lowest level for which cash flows are identifiable cash flows are largely independent. So it seems like we're sort of shifting gears in the middle of the impairment allocation.
Any thoughts either?
This is Eric West. Christine, I'm not sure where your idea that fair value means something other than fair value as defined in the codification comes from. Because I think you're referring to entity-specific value, but nothing in 926.20.35.19 would suggest to me that I use anything but a marketplace participant exit value for fair value.
So where I'm getting that from, Eric, is 926.20.35.13 through 17 that talks about how fair value should be estimated using the cash flows expected to be generated from the film and taking into consideration any costs to complete and so forth. So this, Adriana, do you want to weigh in on this? I mean, my understanding is that this was guidance that was carried over before the definition that we have currently of fair value and an exit notion existed.
Right. So to be clear, so we did not address fair value accounting in this project at all. I think it's been raised a couple of times during the working group conversations, but we have said that this wouldn't change how you currently assess fair value. That said, the guidance in the COD does come from SOP 002. Therefore, I think there's additional fair value guidance that you wouldn't generally see under newer topics and discussed in a way that we used to discuss fair value.
Yeah, I think when FAS 157 came out and doing the COD, they didn't look at the industry-specific guidance because the COD wasn't in existence. Having said that, to Eric's point, I think there is diversity in practice in what people do in determining fair value. And so I think there was somewhere in, and I'd have to go back to the specific paragraph, but almost saying this is one way you can calculate fair value. Based on our outreach, there are other ways that people aren't just doing a discounted cash flow. And so even back to the issue that we addressed with amortization, some entities even today, without all of the film group guidance, will determine the fair value of a film based on a hypothetical license. They'd say, if I have another film that's similar, I know the rates that I charge to license this to a third party, and so I'm going to do some comparisons and a market approach to say, what would I license this to a third party for, even though I'm putting it on my own platform. And so that's kind of where the staff at least was comfortable with the disconnect of, okay, well, when you're determining impairment at a film group level, you're really saying we don't want to have to do that hypothetical license fair value or some other method to determine the fair value of every single film to determine whether there's an impairment. We just want to do the cash flows of the whole film group, which is all your subscription revenue. But then if we determine that there actually is an impairment, to do the allocation of that, if it's obvious that something is a fair value of a really big hit that's on your platform, you don't want to allocate it to that. You could maybe then do the hypothetical license value based on a market approach fair value to then say, hey, I'm not going to allocate the loss to that particular film. And so at least that's the thought process that the staff went through.
Okay, so to just clarify all that then, so when the term fair value is used in 19, we're talking about an exit notion of fair value, which is independent of the entity, what a market participant would consider, irrespective of all of the discussion that precedes that in the guidance that talks about the company figuring out whether they have costs to complete and all the rest of it, it's entity specific.
We weren't explicit on that. And so I think, again, what we were thinking when we wrote this guidance was that someone may use a hypothetical license value to determine what the fair value of the individual film is, but we weren't specifying an exit price or an entry price or entity specific price.
Isn't the result of the guidance in 3519 that you take a loss equal to the amount of the impairment of the group?
Yes.
And the only question is, how are you going to measure the individual films within the group as a result of that loss? So you're going to, basically the issue here is whether you, whether you're going to play every, estimate the fair value of every individual film, and if you can't do it without undue cost and effort, then you won't, and you'll just allocate on a carrying amount basis. But you're going to take the full impairment either way.
Right.
Correct.
Yeah, my concern is that we're imposing undue cost on entities, because what I'm worried about is auditors saying that it is conceivably possible for them to go through and do this license model to figure out what the fair value is on an individual film level. And so there will be sort of this expectation that they will have to fair value all of the films within the group to ensure that they're not allocating below the floor. That's my worry.
I would also share that worry. And going back to comments that Tony made earlier, the complexity as it goes into the group and what the entity's overall business strategy is with respect to monetizing a group. Value will accrue from a variety of sources that are not distinct to the individual titles necessarily inside that group. I might sell ads against that subscription, and the density of my library is attractive to the people who want to place ads on that platform. There's a brand element of it. The overall density of the library as it grows becomes more attractive. Is my subscription base growing? Is it growing at an accelerated base from a user perspective, or is it decelerating? All these are considerations, I think, with respect to how fair value accrues to that asset group. And, and due to that, once you move into that group, it becomes a allocation scheme to try to associate value. But, the more granular you become, the less clear and specific identity you have. Right. And I just think we need to be thoughtful about that.
Let me add one final point, or at least from my perspective, one final point. The language that we put in 3519 came directly from 360, 10, 35, 28, and understanding that the fair value may be different because of the
Right.
definition in 92620, but it's the same undue cost and effort notion.
Yeah, and I understand that, but that switch from an exit price to the potential that this fair value is based on the cash flows to the entity is not a minor switch. So my concern is that we've put it into a group because we're saying that the cash flows are not unique to the film, but are shared within the group. And then we impose a fair value floor that says, oh, but now you have to be able to estimate those cash flows at the film level. So my concerns are that I find that logically inconsistent, but then on top of that, my worry is I'm not sure how auditors are going to interpret this, and I don't want to, I think it would have just been easier if we just stopped at said, allocate on the basis of relative carrying amounts of the assets and don't go below zero, and we're done. I don't understand why we have to make it so much more complicated and introduce what appears to be a logical inconsistency for those who are interpreting fair value as cash flows to the entity from that film.
Yeah, just not to beat on a dead horse, but I agree with that. And if there's a perspective that the sum of the individual titles, the fair value of the sum of the individual titles is going to give you the fair value of the group, I think that's misplaced. It actually happens in reverse. You have a fair value of the overall group, and then you have maybe some mechanism by which you can apportion it to the individual titles.
Any other thoughts or concerns about the paragraph that Christine raised, or perhaps her suggestion on striking part of it?
Sue, this is Larry. So with regard to 92620, 3519, the language there, my understanding, it's consistent with what Jason said. That language exists in 360. It is how the 360 works, exactly as described here. My experience has been that, generally speaking, most people would allocate the loss on a pro rata basis. Having those words there just allows for the very unique, unusual circumstances where fair value may in fact be so determinable that it makes sense to, limit the loss that's allocated to a particular film. Doesn't happen very often, just like it doesn't happen very often in a 360 test. But in my mind, it's consistent with, the notion that we have in 360. Don't think in this space where the fair values are going to be all that frequently different between the exit price notion and the cash flows, the way that it's described in 926. So I'd recommend just leaving it the way it is, and people have the opportunity to just allocate it on a pro rata basis if they're saying they can't determine fair value. So I would leave it the way it is.
This is Eric West. I would leave it the way it is, too, because I think what this guidance does is, what if I recently produce a film and I just put it into my film library? I certainly wouldn't want to then immediately write that down because there's been some sort of impairment. So I think you need a mechanism to have a disproportional allocation of an impairment.
Jim Croker?
So if people say generally the allocation is pro rata, this seems to flip it and say you could only do pro rata if you can't determine fair value. One way to address that would be to say pro rata allocation is acceptable. If an entity wants to do something other than pro rata, they have to have a systematic and rational approach to that. That might turn the default to not having to worry about the fair value of every individual film unless an entity wanted to. And I get that that's inconsistent with how 360 works. There might be reasons for that inconsistency in that here we are talking about the lowest level of cash flows is likely the group. So pro rata might just be an easier default for those who want to default to it.
Thoughts? Okay. Any other, so we're looking at question 3, 4, 5, and 6. Any other observations before we sort of see where we are? Okay, so the staff's recommending that the task force affirm the consensus for exposure for the proposed definition of a film group, the proposed impairment indicators, and the use of a film group as a unit of account for impairment testing. The staff's recommending requiring reassessment of the predominant monetization strategy of a film when the monetization strategy of that film significantly changes from the strategy determined when the capitalization of the film costs began. And we've made a recommendation in paragraph 33 of the issue summary supplement with an additional impairment indicator as described there. I think based on the conversation that we had around this, I think maybe we need to put some either additional words around this, either in the form of implementation guidance, an additional implementation guidance, or perhaps an example, or for example, or perhaps some discussion much in line with what we've had here today in the basis, so that there's some perspective on what the intent is associated with this impairment indicator. In addition, the staff recommends that the task force affirm the consensus for exposure to require entities to apply the impairment model for films within the scope of subtopic 92620 to license agreements for program material within the scope of 920-350. So by show of hands in the room, who would agree with that and affirm with some additional improvements to the language and what I had said about predominant monetization strategy? Is that okay? 2 in the room. On the phone, Paul?
I would affirm it.
Okay. Jim?
Affirm, subject to your comments, yeah.
Okay. Alex?
Affirm.
Larry?
Agree.
Brett?
Affirm.
Mark?
Affirm.
Tony?
I disagree because as I said earlier, I think it's far too situation specific and doesn't take into account what's going to happen.
Okay. Eric?
Affirm.
Okay. Okay, so with that, let's move on to presentation.
Yes.
And disclosure.
3 of the 6 respondents explicitly stated that they were supportive of aligning the presentation and disclosure requirement between subtopic 92620 and subtopic 920-350. And the other 2 respondents noted that they were generally supportive of the proposed changes. One respondent indicated that it is not relevant to provide separate disclosures for produced and licensed content when that content is monetized as a film group. 5 respondents were opposed to separate disclosure for theatrical films and direct-to-television products because they noted that the distinction between content formats is less relevant under today's business models, and therefore the disclosures do not provide useful information. Each respondent suggested alternatives to the separation of theatrical films and direct-to-television products. One respondent recommended that subtopic 920-350 required that prepayments for licensed content be presented and disclosed in accordance with topic 920. Based on the feedback received, the staff recommends that the task force affirm its consensus for exposure to amend the presentation and disclosure requirement in subtopic 920-620 and subtopic 920-350. The staff also recommends that the task force amend paragraph 92620-50-2 to require disclosure of the components of film costs separately for films predominantly monetized on their own and for films predominantly monetized with other films and license agreements, and make conforming amendment to the disclosure requirements in paragraphs 926-20-50-4A and 4B. The staff acknowledges that the distinction between theatrical and direct-to-television is less relevant under non-traditional business models. However, during outreach, users indicated that some distinction from different types of content is important for traditional entities that have different monetization strategies for the content because of the different risks and the extent of cost incurred for each. The staff believes that separating the components of film cost and amortization by predominant monetization strategy could provide users with information about the costs a traditional entity is incurring to compete with services of non-traditional entities and will meet the needs of users based on the outreach performed. That would align the disclosure requirements with the decision that the task force made about amortization and impairment due to the changing environment in the entertainment industry. And now I'll turn it over to the task force for discussion and questions on issue 6.
Any thoughts or observations in the room? On the phone, any thoughts or observations? Okay.
This is Larry. We thought, the change that the staff was recommending to the disclosures was moving in the right direction and moving away from, the films and DTC to more consistency of individual film versus, part of the film group. Maybe a question that we had that we were just kind of curious to get feedback from a user's perspective is that, when a film that is predominantly monetized on its own moves, to later stages in its life and is now part of the platform, the notion that the disclosures will still separately present those films as being on its own, having that disclosure being separate from the rest of the platform, whether that is particularly helpful to users or makes sense. It was, we struggled a little bit with it, but I understand that's the accounting model that we're following. But I was curious whether users would be confused with that notion. So I was really more of a question for maybe some of the users on our group to see if they had any concerns about that.
Any thoughts, Mark, or any of our board member users?
It's not something I'd given particular thought to before, so I don't have a view at this time.
And two, it actually doesn't bother me that much. But I certainly will take a look at it. At the moment, my initial reaction is that it's not that much of an issue.
Okay.
My reaction to it is I just didn't understand what was driving it in terms of, and maybe somebody can elaborate from a user perspective of why the distinction between licensed content and development content with respect to disclosure was important. I would I would agree with some of the comment letters of, is this really necessary? I just don't understand the underlying concern that's being addressed with the discrete disclosure for each.
You want to share some of the information we got from our outreach?
So I think that from what our understanding is that licensed content have different characteristics than produced content, and because that involves different type of risks, it is important to have them distinguished, and it is important for users to know which one is licensed and from which one is produced.
And Jim, I think they also, in addition to the risks, seems to me they have different implications for revenue and how and what the growth rates will be.
Yeah, I get maybe Eric can weigh in from a business model perspective. I mean, the way I see it is licenses is content spread over time, and when I DCF it back, maybe it's a shared risk model with respect to developed content, right? Whereas development content is going to be more of a front-loaded. I can appreciate that the a particular entity that participates in this area, the level of developed versus licensed might be a indicator of strategic intent or level of market intentions, but that isn't typically something that we would incorporate into disclosures.
It's a different business.
Yeah, I'm not so sure. I mean, I would actually contest that. It's becoming it's losing that distinction as a distinct business.
No, I'm sorry. What I meant was that in response to your comment that this is not something we typically find in disclosures. What I'm saying is what we're doing with licensed and developed content and what we're doing with these different monetization strategies for films and television, that the nature of that business suggests that this may be a useful disclosure.
Okay, I understand.
Any other thoughts or observations on this point? Okay, in question 7, the staff's recommending that the task force affirm its consensus for exposure to amend the presentation to disclosure requirements in subtopic 92620 and subtopic 920-350 with the staff's recommended change to separately disclose components of film costs and amortization for films that are predominantly monetized on their own and films that are monetized with other films and license agreements. Who would agree with the staff's recommendation based in the room by show of hands? Okay, there's 2 in the room. On the phone, Paul Beswick.
I would agree.
Jim Campbell.
Supportive.
Alex Quarrell.
Agree.
Larry Dodig.
Agree.
Brett Dooley.
I agree.
Mark Lamont.
I agree.
Tony Sandi.
Agreed.
And Eric West.
Agree.
Okay. Thank you. So we'll move forward with that based on the recommendation. We're in the home stretch. Transition and transition disclosures.
The 4 respondents that provided feedback generally supported the proposed prospective transition requirements. However, there were different views on how the prospective transition method should be applied. For transition disclosures, all 4 respondents who provided feedback were generally supportive of the transition disclosures. Based on the feedback received, the staff recommends that the task force require an entity to apply a prospective transition method when adopting the capitalization, amortization, impairment, and disclosure guidance in the amendments resulting from this issue. The staff recommends that the task force require entities to apply the amendments resulting from this issue to the capitalization of film costs, impairment, amortization, and presentation and disclosure guidance at the beginning of the interim period that includes the adoption date. The staff also recommends that the task force affirm its consensus for exposure on the transition disclosures. And with that, I will turn it over to the task force for discussion.
Any questions or concerns with what the staff's proposing in the room or on the phone? Okay. Does anybody disagree with what the staff's proposing on questions 8 and 9 or 9? Okay.
Sue, this is Larry. We don't disagree with the staff's recommendation, and we understand the notion of why the staff is proposing that it would be done prospectively, that beginning in the interim period of adoption. The one question that I think when we did our outreach had to do related to presentation. There was some thoughts of, people might, would have liked to have seen if they were changing things that maybe in the past would have been shown as current and now will be shown as non-current on the balance sheet. That they might want to do that comparable in previous periods, but we understand the concept after discussing with the staff of you can't kind of pick and choose, which things you can do for prior periods or not. But we thought it might be helpful to at least put in something in the basis for conclusion that kind of explains this notion about why you wouldn't restate the comparable prior period for the presentation, and maybe even including something that says that there's nothing that precludes an entity in its disclosures to provide additional information that might enhance comparability for that. So that might be one thing we would like to see added to the basis.
I'm not sure that that's something that we have typically done in the past. I would welcome any thoughts or observations from other task force members. Kimber?
I was fine with the staff recommendations as they are articulated in the paper.
Bob's shaking his head as well, just to verbalize it. Others on the phone, just reaction to Larry's suggestion?
I was fine with the staff recommendation. This is Paul.
Okay. Okay. Bob?
Just for the staff, just clarification. Because we said predominant monetization strategy is determined when you start to capitalize costs. But for somebody who is transitioning, I would assume we're going to have a paragraph that says you would determine for all your films that you have existing that the predominant monetization strategy at the date of adoption, instead of we began costs because they didn't do it back then.
Yeah, that makes sense. We hadn't really started that drafting, but I see your point, and we'll make sure to address that.
Can we move on to issue 9, 10, and 11? Questions 10, 11, and 12.
Two respondents provided feedback on issue 9, and both indicated that the amendments in the proposed update should apply to private companies. The staff recommends that the task force affirm its consensus for exposure to apply the amendments resulting from this issue to private companies. 4 respondents addressed the effective date and early adoption. All 4 respondents indicated that the proposed amendments would not take significant time to implement under a prospective transition method and supported early adoption. 1 respondent supported giving private companies additional time to adopt the proposed amendments. Based on the comment letter feedback and estimated issuance date of a final update Q1 2019, the staff recommends that for public business entities, the amendments be effective for fiscal years beginning on or after December 15th, 2019, and interim periods within those fiscal years. For other than public business entities, the staff recommends the amendments resulting from this issue be effective for fiscal years beginning after December 15th, 2020, and interim periods within those fiscal years. The staff also recommends early adoption be allowed in any interim period. Now I'll turn it over to the task force for discussion and questions on issues 9, 10, and 11.
Any questions or comments, observations on these 3 questions? Bob?
Shaking my head,
Oh.
no.
Oh, okay. Anybody on the phone? Okay, so for questions 10, we're recommending that this consensus for exposure, this final consensus applies to all companies. We're recommending that the effective date for public business entities be for fiscal years beginning on or after December 15th, 2019, and including interim periods. For other than public business entities, we're recommending a 1-year delay for them, which would be for fiscal years beginning after December 15th, 2020, and interim periods within those fiscal years. And we're also recommending we allow for early adoption. Does anybody take exception to those recommendations, either in the room or on the phone? Okay. Next issue. Adriana?
Issue 12. Now the staff will discuss 2 additional issues raised by respondents related to cash flows and amortization. 2 respondents recommended aligning the cash flow presentation for topic 926 and 920. Topic 926 requires that cash outflows for produced content be reported within operating activities in the statement of cash flows, whereas topic 920 doesn't contain a similar requirement. Thus, diversity in practice may exist in how entities report cash outflows for licensed content under topic 920. The respondent recommended that cash flow presentation guidance be added to topic 920. The staff believes that the request to align the cash flow requirement in topic 920 with topic 926 is consistent with the views expressed by both preparers and analysts, that licensed and produced content are analyzed together when users are assessing an entity's portfolio of content. Therefore, the staff recommends topic 920 be amended to require that cash flows for licensed content be classified as cash flows from operating activities within the statement of cash flows. For amortization, 1 respondent noted that the guidance for reassessment using the individual film forecast method would be inconsistent with the proposed amendment in paragraph 926.20.35.3a, which would require an entity to reassess the estimates of use of a film in a film group prospectively, that is, not as of the beginning of the fiscal year of change. To address the inconsistency, that respondent suggested amending paragraph 926.20.35.3 and 926.20.35.1 to replace the language about the beginning of the fiscal year of the change with beginning of the current reporting period. Considering that the amendment suggested by the respondent was rejected by ACSEC, the approach in paragraph 926.20.35.3 is currently used in practice, and only 1 respondent made the recommendation, the staff does not recommend amending the guidance in paragraph 926.20.35.3. However, if the task force does not agree with the staff's recommendation and decides that the recommendation should be addressed, then the staff would need to conduct research and perform outreach activities before moving forward. Now I'll turn it over to the task force for discussion.
Any thoughts or observations, Bob Yule?
On the cash flow issue, agree with the staff on the direction of travel. Makes sense to me. My question really is more of a due process, because we didn't expose the change to 920. Can we make that change?
I think that in this instance, the feedback that we got from our outreach of the, and the exposure of our proposed update yielded this feedback that we're reacting to. So, you'd have to make your own determination as to whether you think you have enough feedback on it to make the determination whether you've got enough to make this decision in the context of the overall project. Others?
I'm supportive of the staff recommendations in both cases in this issue.
On the phone?
Supportive.
Okay. So, is there anybody that takes exception to the recommendations that Adriana outlined on both these issues as it relates to cash flows and the amortization using the individual film forecast method? Okay. All right. So, so we've reached the end of our questions. Is that right? So I guess I'll ask the question as to whether the task force is supportive of a final consensus on this issue based on all of the dialogue and decisions we've talked about today and all of the incremental clarifications we may need to make in certain areas. By show of hands in the room, who would support a final consensus? That's 2. On the phone, Paul Beswick.
I would support it.
Jim Campbell.
Yes.
Alex Coral.
I support it.
Larry Dodick.
I support it.
Brett Dooley.
Support it.
Mark Lamont.
I support it.
Okay. Tony Sandy.
Yeah.
And Eric West.
I support it.
Okay, great. I appreciate everybody staying on a few extra minutes so that we can finalize this issue. At this point in time, I'll turn it over to Jason for any closing announcements.
So just a couple of closing announcements. Wanted to provide a quick update on issue 18A, which is recognition under topic 805 for an assumed liability in a revenue contract. That proposed update is to be issued concurrently with the related invitation to comment, and we're hoping to get that out by the end of February, with the board had previously decided that a comment letter deadline of April 30th, 2019. On the invitation to comment, which would be entitled Measurement and Other Topics Related to Revenue Contracts with Customers, under topic 805, a draft of that will be distributed to the task force today for review with comments requested by next Friday, January 15th. And again, that would be issued concurrently with the related proposed update with a comment letter period ending April 30th, 2019. The first draft of the final update on the film costs issue will be available for task force review next week on Thursday, January 24th, with comments due the following Thursday, January 31st. The board ratification meeting to ratify this consensus reached is scheduled for January 30th. Then on the next meeting, the next regular meeting is scheduled for March 21st.
Okay, with that, we're adjourned. I'd like to thank everyone for their participation by phone and in person. I know it's not always that easy to do these meetings by phone, but the ability to be able to finalize this issue is really helpful for those that it impacts. So thank you, everyone. And we're adjourned.
Everyone else has left the call. Everyone else has left the call. Goodbye.